And wait till you see this one chart. It's got receipts, literal proof of when some buyers got absolutely wrecked by bad timing. Canada's housing market is cracking under pressure. According to Equifax latest national credit report, over 1.4 million Canadians are now behind on debt payments, not just mortgages, but credit cards, auto loans, and lines of credit. And here's the wake-up call. These delinquency rates haven't been this high since 2009. It's not about high interest rates anymore. We're witnessing a real-time credit crunch across Canada, especially in hot real estate markets like Toronto, Vancouver, and Calgary, and pretty much throughout the GTA. Credit is tightening, lending standards are shifting. Oh, and wait till you see this one chart. It's got receipts, literal proof of when some buyers got absolutely wrecked by bad timing, lost it all. This is the chart no one wants you to see, and it might just blow your mind. If you're watching this, take 2 seconds, hit like, share this video, and subscribe to the channel. This helps grow the platform so more people get the truth. Now, let's zoom in, shall we? In Ontario, loan delinquencies rose 24% year over year. That's not just an uptick, that's the blowout. Alberta and Quebec also saw double-digit increases, and younger Canadians, Gen Z is getting hit the hardest. Defaults on auto loans are up nearly 30%. Credit card delinquency rates in that group have jumped over 20%. So what are the banks doing about it? Lenders are reducing exposure to residential mortgages, especially in over-leveraged markets, because let's face it, we've seen a big uptick in mortgage defaults. Let me show you why. Let's look at something that's called the Benchmark Price Composite Index. It refers to a model-based estimate of what a typical home is worth in a specific market with average features. This is used to create a general trend in the market. So let's take a look at the benchmark price composite for the GTA ranging from January of 2020 to May of 2025. This is the raw truth. Are you all ready for this? Let's look at this. It may shock some of you. So there was buyer A who was in the market to buy a property. So they ended up buying a beautiful little trending home with average prices looking at $824,700 in April of 2020. Yes, those were average prices back then. So they didn't have enough money to make any upgrades, so they just sat there and just kind of lived there in lockdown because there was really not much to do. But anyways, so they sat there and casually looked at their equity and saw less than a year later, their same property had gained equity, and now it's worth $995,900. Life is good. So then the Bank of Canada came along and they dropped the rates like they dropped their pants. And then, oh, look at this. In February of 2022, which happens to be the peak of the market, that very same property is now worth $1,281,900. And guys, yes, this was done in less than 2 years. Where are you going to make all that money in less than 2 years? So they gained $457,200 in equity from the point of when they bought to this peak of the market. So buyer A decides to say, well, I don't think this is going to sustain itself. I'm just going to sell it. So the couple went ahead and sold their property. And buyer B picked it up in February for this price, $1,281,900. Buyer B decides to put a 10% down payment. That will come into an equation later on. So then the Bank of Canada decides to aggressively go the other direction and increase the interest rates. And we all know what happened. So let's look at the bottom of this little hill. Now that property is worth $1,028,500. So there is a difference of over $200,000 equity lost. So this is at a point where a lot of buyers are saying, oh, this is a great time to buy. Prices are still going to go up. It's just going to continue because our population is still expanding and there's still demand. Prices are going to go up, and they did go up. About $100,000. Great. But it didn't go the direction where a lot of people thought, like it was going to continue. It just kept going. We went down the hill again. So now let's just say that buyer B, who bought in February of 2022, now has their mortgage coming up for renewal. And their mortgage rate was so rock bottom low, like under 3%, and it's coming up for renewal in June of 2025. So buyer B decides to sell their property. And by the end of May, the property is now worth $1,012,800. So they bought the house for $1,281,900. They put a 10% down payment down, so they put $128,190. So now they have a loan amount from February of 2022 for $1,153,710. And now let's just say after 3 years, they pay down about $100,000 of principal because borrowing money was so cheap. So now they're left with a loan amount of $1,053,710. But their home value is only worth $1,012,800. So from when they bought at the peak to what it's worth today, it's down 26% or 26.5%. What are they going to do? Well, believe it or not, this is a very subtle example. There's examples where there's a bigger difference between the loan amount and the existing market value that people just walk away. That's not for all, but for some. But I've been seeing a lot of power sales like this, and I'm sure you've been seeing it online as well, where you're saying, 400K loss, 500K loss. They don't see it's worth going ahead and selling it and then having to incur that loss. They just wipe their hands clean and walk away. And believe it or not, there's a lot of small lenders, I've actually heard just about a couple of weeks ago, that went belly up because they lended out so many mortgages in 2022 and the values did not keep up with what they lent out. So the lenders ended up taking the hit. Now, behind the scenes, credit availability in Canada is drying up so fast, not just from mortgages, but from HELOCs, which are your home equity lines of credit. They're being slashed. Pre-approvals are being pulled, mortgage qualifications recalculated mid-deal, sometimes at the end. This has to be one of the biggest misconceptions. Buyers think once they are approved and receive their mortgage commitment that they're smooth sailing. This is completely false. Lenders can reassess right up until closing because at the end of the day, banks are protecting themselves. They're not in the business of taking risks they didn't sign up for, and they're sure as hell not looking to be left holding the bag. I've seen people lose access to $100,000 in credit without a single missed payment, not because they did anything wrong, but because their risk profile changed in the bank's eyes. Welcome to the new reality. And let's be clear, this isn't just about mortgage interest. This is about liquidity, about credit flow, and about the institutions trying to reduce exposure before defaults surge even more. Now let's talk about how this ripples into real estate, especially in markets of the GTA. We've got listings rising, buyers pulling back, appraisals coming in low, and sellers, a lot of them coming out of 2021 price appreciation, insanity, and realizing their homes dropped in value. On top of that, rents are slipping, lease volume is up, one bedroom and studio units are sitting longer. No one wants a 350 square foot box anymore. Investors who were banking on rent appreciation are suddenly watching their margins disappear. The reliable cash flow is gone. Pre-construction buyers are in an even tougher spot. I know investors right now whose appraisals came in $150,000 lower than the purchase price. They're being asked to cover the gap because the home's value didn't appraise like it did before. But here's what people forget. This is how a housing market reset actually begins. Not with one big crash, but with a slow, grinding shift where credit tightens, confidence fades, and people quietly begin to scale back. So here's the $1,000,000 question. What do you do? Because this is where the fear-based thinking comes in. People say, well, I'll just wait it out, or maybe it will bounce back soon. And sure, sitting still might feel safe, but in this kind of market, waiting without a strategy is the biggest risk. Here's the truth. Opportunities don't disappear in downturns. They just change shape. And the people who adapt, they come out ahead. There are properties right now sitting on the market that would have not lasted 2 days in 2021. There are sellers who are motivated but just haven't accepted their new price realities yet. There are investors pivoting into smaller, better located properties that actually have positive cash flow. Others are stuck with a downtown condo bleeding $800 a month. You do not need a booming market to make a great move. What you need is clarity, a plan that's grounded in today's numbers, not yesterday's emotion. I know some of what I've mentioned in the past may seem pessimistic, but I'm not sugarcoating the truth. And yeah, this is the part where I remind you we work in this market every single day. I just don't make YouTube videos. Buyers, sellers, families, downsizers, we deal with them all. Some are moving fast, some are planning 6 months out, but all of them are making informed strategic decisions, because pretending that the market hasn't changed, that's not a strategy. And if you're someone watching this thinking, yeah, I feel stuck, I want you to know that you're completely not the only one feeling this way. You're not the only one facing a massive payment spike at renewal or sitting on equity and unsure if now's the right time to move. But I promise you this, with the right plan, you can still move forward. It might look a little different than what you initially expected. Maybe it's not the detached you dreamed of, but it's a smart semi in a great school zone, keeping your costs down. Maybe it's not that 1.2 million pre-construction you bought at peak, but a duplex that pays for itself. There are still ways to win. You just need to stop listening to people selling you future hope and start listening to people speaking reality. I'll give you an example. A couple I recently worked with bought a townhouse in Vaughan. They were nervous, market was shaky, and they didn't want to overpay. Completely understand that. We broke it down, looked at rental comparables, location upsides, and we negotiated the seller down, matched their closing date because they bought another house already. We cleaned up our terms, and now they're paying less than rent and already building equity because we negotiated a price that made sense to the buyer. And we removed the bloat from the price. That's not luck, that's strategy. There are many motivated sellers like this. You just need to find them, determine their motivation, and go in for the deal. Another situation, an investor of ours who walked away from a money pit in North York and reinvested in a triplex in Simcoe with reliable tenants, way better cash flow, and less overhead. It's not glamorous, but it's smart. It makes them live life a lot simpler. So don't buy into the narrative that everything is falling apart. Yes, the market is tightening. Yes, the economy is under stress, but that doesn't mean you have to be. If you have a plan, if you stay calm, if you ask the right questions, you will find your window of opportunity. That's how smart money moves. So please, like this video, share it with someone renewing a mortgage this year. Subscribe to the channel. We've got deep dives coming up like the 2026 mortgage renewal wave, the next Bank of Canada rate decision, and how all of this is impacting home values across the GTA. And drop a comment below. Are you seeing homes sit longer in your neighborhood? Are you hearing about people walking away from big deposits on pre-construction deals? Let's talk about it. Let's normalize having real conversations, not fear-mongering. Because we're all been fed the idea that housing market always goes up, that it's always safe, that it always recovers. The ones who stay informed and adaptable are the ones who come out ahead. So stay sharp, everybody. Stay strategic, and remember, in every market, up or down, there's always a smart move. You just have to find it with the right people.